Hey there, my name is Patrick Kamau Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson where we learn more about the taxation of the business income and which we started sometimes back in few lessons, past lessons, where we say that we are supposed to look at the taxation of the business income, and we had 3 businesses we are supposed to look at: the sole proprietorship, partnership, and the limited company. In our previous lessons, we have covered the sole proprietorship and the partnership. So what is remaining is the taxation of the limited company, and it is the one that I want us to look at how it is usually taxed. So this is what you need to know about the limited company. That limited company is considered to be a separate legal entity from the owners, and therefore taxed on its own income, and therefore taxed on its own income at corporate tax rate. That is the first thing that you need to know, that a company is considered to be separate from the people who forms it. So when you're taxing a company, you tax the company itself. You don't tax the owners. Unlike the case of sole proprietorship, which you tax the owner, the partnership where you tax the partners, here you tax the company itself. So the following points are considered when you are taxing the company. So points considered in taxation of a limited company. There are only 2 points that you need to consider when you are taxing a company. One of them is this. 1, or A, determination of the taxable income of taxable incomes. So this is determined using either number 1, gross profit method, number 2, net profit method. So what we are saying here is that when you are determining the taxable income of a company, you just determine it in the same way as any other business, the way we have been using it. Either gross profit method, if you have not been given net accounting profit. If you have been given the net accounting profit, then you use the net profit method. It's the same thing. Point B to consider is that taxable income of company is taxed at the following tax rate. 1, resident company, 30%. Number 2, non-resident company, 37.5%. But note, so what we are saying is that when you determine the taxable income of a company, if it is a resident company, you tax it at 30% to get the tax to be paid. If it is a non-resident company, that's 7.5%, then you get the tax to be paid. But note, from 1st of January 2024, non-residents will be taxed at 30%. Yeah. So there was a change of the law on 1st of July 2023, which stated that come January 2024, the non-resident corporate tax rate will be reduced from that 7.5% to 30%. So it's good to know when you are taxing a company, which year is it rating to? Any year before 2024, that is 7.5% for non-resident only. And now beyond 2024 or 24 and beyond, then it's supposed to be, that is 30%. That is all that you need to know. Otherwise, everything else that we have been talking about taxation of a business, in terms of the method, in terms of the taxable operating income, non-taxable operating income, allowable expenses, and non-allowable expenses remain the same. So now we look at a question. This is what the question says. Zahari Processors Limited presented the following statement of profit or loss for the year ended 31st December 2022. We have the turnover, cost of sales, gross profit, other incomes, provision for foreign exchange gain, gain on sale of motor vehicle, release of liability, refund of excess duty, investment income gross, total income, less expenses, purchase of trademark, a design of company website, director's fee, donation to charitable institutions, depreciation expense, marketing expense, management and professional fees, general expenses, legal costs, loan repayment, allowance for doubtful debts, impairment loss of property, a net profit for the year. Additional information number 1. On 1st April 2022, the company acquired the following assets: factory building, warehouse, processing machinery, rolling 4 tons, drainage system, saloon car. Number 2, management and professional fee comprised development of strategic plan, tax consultancy fee, audit fee, environmental assessment fee. General expenses include installation of neon sign, car grant to a director, installation of processing machine, staff Christmas party, retrenchment costs. Number 4, legal fee comprised defense against claim for breach of trade agreement, renewal of Kenya Association of Manufacturers membership fee, negotiating a bank loan, a preparation of employment contract, drafting lease agreement 60 years. Number 5, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due for over 4 years. So we are required compute the total taxable profit or loss for Zahari Processors Limited for the year ending that 1st December 2022. So we want to get the taxable income. First thing that we need to ask ourselves, which method are we supposed to use? It's obvious that for this question we are supposed to use the net profit method because we have been given the income statement with net profit, but the key we have been given the net profit, or if we are given the net loss or net income, is the same. So we'll start. So we'll start with the net profit that has been provided to us. Which we have, note that the items have been given shillings 1,000. So we have 527, 614. And then we add non-allowable expenses. In P&L and taxable operating income, not in P&L. So, as we have been doing any question that we use the net profit method, we just need to go to the P&L, look for the non-allowable expenses there. The first expense in the P&L, purchase of trademark. Trademark is not allowable. The first expense in the P&L is trademark, which is not allowable. So we add it. Then we continue. The next one is Design of company website. Website is a fixed asset which we should claim capital allowance later. It's not allowable. So we add it, which we have 12,400. The other one is director's fee. Director's fee is allowed if you look at what we had said among the allowable expense initially. Donation to charity, that's allowable, we said. Depreciation, no, that is not allowable. Depreciation, which we have that 240. After the depreciation, marketing expense. Marketing is allowable. A management and professional fee, that is also allowable, we said, because it's for the business. General expenses, they are allowable because they are for business. Legal costs, unless it is stated what it is, it's allowed, which we had already looked at the non-allowable legal cost. Loan repayment, no, that isn't allowable. Loan repayment, which you have 2,600. Then the next one is allowance for doubtful debt. Allowance for doubtful debt is not allowed. It's a provision. Unless they say specific allowance, it's not allowable. Which we have 2,250. The next one is impairment loss of property. We don't allow impairment loss. We don't. So impairment loss, which we have 1,500. Seems we are done with non-allowable expense in P&L, but we need to go to the additional information, check if there is further analysis of expense in the P&L, and if there is a part that is not allowable. At the same time, in the additional information, we look for taxable operating income not in P&L. An income that is taxable and is operating but has not been included in the P&L up here. So let's see. Additional information number 1. On 1st April 2022, the company acquired the following assets. Now, those are fixed assets. First, they are not in the P&L. If you go to the P&L expenses, they are not there. So ignore. Number 2, management and professional fee comprised. Now, that is in the P&L. We have to look for non-allowables. Higher. Development of strategic plan. That is an allowable expense because when you plan for your business, it's income generating, it's allowable. How about tax consultancy fee? No, anything to do with the tax we don't allow. Tax consultancy fee, which you have 208. The next one is audit fee. Audit fee is allowed. Environmental assessment fee, that is supposed to be an allowable expense. Why? It is not income generating. We said any expense that is not income generating is not allowable. So environmental assessment, which we have 256. After that, we go to number 3. General expenses include. Now, general expenses is in the P&L. When you go to the P&L, you find the general expenses there. They include installation of neon sign. Neon sign installation is a fixed asset. Expense incurred before you start using the neon sign, the fixed asset. Those we don't allow. So, we disallow. Which we have 820. The other one is car grant to a director, also not allowed because a grant to a director is a private, for private use. We don't allow. Which we have 2,800. The other one is installation of processing machine. We don't allow installation of the process. They are fixed asset. Expense incurred before you start using fixed asset. We don't allow them. which we have 1560. The other one is staff Christmas party. That is now allowed because we said expense for the welfare of workers, they are allowable. That's for welfare. The other one is retrenchment cost. We don't allow retrenchment cost. Expense that is not income generating, we don't allow. Retrenchment costs, which we have 580. After that, we go to additional information number 4. Legal fee complies. Now, legal fee is an expense and it is in the P&L. We look for the non-allowable in it. Defense against breach of trade agreement. We don't allow breach of trade agreement. Breach of contract. We don't. Which we have 1450. How about renewal of Kenya Association of Manufacturers membership fee? That's a trade association. We said anything paid to a trade association is allowable. Negotiating a bank loan, no. Bank loan cost, not allowed. Which we have 1168. 68. The other one is preparation of employment contract. That is allowed. We said so. Drafting at least 60 years. We said up to 99 years this is allowed. So we are done with legal. Number 5. Release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. Here we said, that's an income. The income you are interested with is the one not in P&L for now. For that one, if you go to the P&L, you'll find it as one of the income in the P&L, in the income statement. So we ignore because we want the one not in P&L. Now that we are done with the addition, we come to the deduction now, less. And we list 3 items as we said. 1, non-taxable operating income. In P&L, that is 1, or in investment incomes, in P&L, and allowable expenses, not in P&L. So what we do, or we said, we start with the first 2 items, non-taxable operating income in P&L and all the investment income in the P&L. So let's go to the P&L, look for an income that is there that is not taxable or an investment income that is there. Like, the first income we have is the turnover. Turnover is a taxable income. It's a taxable. After that, there is, because it involves sales, it's sales actually or revenue, what they do. Cost of sales, that's not an income. Right now, we are interested with the incomes. Non-taxable investment. Gross profit is as a result of turnover and cost of sales. Other incomes, which we have, provision for foreign exchange gain. Provision is actually unrealized. If it was just in foreign exchange gain or realized, then that's taxable. But provision is unrealized. So it's not taxable. We remove provision for foreign exchange gain, which we have 84,000. We deduct. The other one is gain on sale of motor vehicle. Income from selling fixed assets we don't tax. Deduct. So gain on sale of motor vehicle. Fixed assets income we don't tax. 28,000. The next one is release of liability. What was the liability about? We were told in additional information number 5, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. But that is not an operating income. So we remove. It's not an operating, it's not even an income, an operating income. So release of liability. Release of liability which you have, that's 2,000. Next, refund of excess duty. excess duty is not an income. You know, you are just being refunded the tax you had paid. It's not an income. So remove. Which we have 16,000. Last three, investment income. Here we are saying that all investment income in P&L we remove. So we remove that investment incomes. So investment income, which we have 24,000, we deduct. For now, up to this point, we are done. So what remains is for us to look for allowable expense not in P&L. An expense that is allowable, but if you go to the P&L, it isn't there. If it is not in the P&L, where is it? It must be in the additional information. So let's go to the additional information and check. Number one, on 1st April 2022, the company acquired the following assets. Well, those assets were not in the P&L, but themselves they are not allowable. What we allow in them is capital allowance or investment allowance. And there is nowhere we are told that this is the capital allowance to use. If you are not told, we said you compute yourself. So we start with, the first one is factory building. Factory building you claim at the rate of 50%. So capital allowance on factory building. In short, I'll write FB, factory building, which we said this being used for manufacturing, factory building, it is 50% of 28,800. That will be 14,400, the capital allowance. And we say that whenever you are claiming 50%, you don't consider the time. You claim for the full year, even if it's 1 day. The other rates, 25, 10, are the one that you consider time. Warehouse, that's supposed to be capital allowance at the rate of 10%. So we'll have here warehouse, which is supposed to be 10%. And then this we said we consider time from 1st April. Those are 9 months to the end of the year. So times 9 over 12 of 2800. That we will compute in a while. The other one is processing machine. Processing machine is supposed to be done at the rate of 50%. That's what we said. So to come here and say processing machine. So this is supposed to be 50% without considering time of 16,000. But we said all the expenses that are incurred before you start using a fixed asset, we add them together and we claim capital allowance together. What I'm saying is this. We had an installation of processing machine here, which we disallowed because it was relating to a fixed asset. Now, because they are the same, now we add it here, which we have 1560. And then we'll claim capital allowance on the total. All the cost incurred before using, like this installation was before use. Lorry, that is supposed to be 25%. This we consider time, 9 over 12 of 3,500. The other one is drainage system. If you look at the capital allowance, we say that should be 50%. So we'll have drainage system, which is supposed to be 50% of 2,600. For the Sarunka, we said it's 25%, and we consider time. However, we had said if a Sarunka or sport utility vehicle exceed 3 million, we only give capital allowance to 3 million. This one is already exceeding, it's 4,840,000, so we only give 3 million. So we have Sarunka. So 25% times 9 over 12 times 3. Now, those being the only fixed asset in number one, we do the computation now. The first one is, we had already done, is 50% of 28,800. The warehouse now, 10%. And then 10% times 9 divided by 12. And then times 2,800. That gives us to 10. The other one, we add the 16,000. We add 1,560. And then we take 50% 8780. The other one is 25% times 9 divided by 12 and then times 3500, giving us 656.25. I want us to round off to whole numbers, so we just have 656. Then the other one is 50% of 2600, that will be 1300. 25% of 9 over 12 times 3, which gives us 562.5. So we round off to whole numbers, 563. Yeah. So we have been looking for allowable expenses not in P&L, and we were in number 1. We found fixed assets that were not in the P&L, and so we claim capital allowance. Let's check for any other allowable expense not in P&L. Number 2, management fee complies of the following. Now all those one are in the P&L, including the audit fee, development of strategic plan. All those were in the P&L through management and professional fee. We said if the heading is in the P&L, ignore. 3 general expenses is in the P&L. Legal fee are in the P&L. Number 5 is not an expense, it's an income. So what did we say? We said if you have not been given capital allowance, we now come back here. Of the expenses that we have added back, if there is a fixed asset, claim capital allowance. We disallow the fixed asset, you claim capital allowance. So in this case, we had a website. Trademark does not qualify for capital allowance. It's an intangible asset. Website is supposed to be at the rate of 25%. And then the other one that we had was neon sign installation. And then the one installation of machine which we had considered there. And there was no any other. So we'll come here, website, which we have 25%. Now this we haven't been told when it was acquired or utilized from. So we take 25% of 12,400. 12,400. For the neon sign, that is supposed to be 10%. Neon sign, 10%. We haven't been told when it was started being used in the business. And here we had 820. So this will be 82. Now we do the website, which is supposed to be 25% of 12,400, which give us that 100. Yeah, that 100. Now with nothing else to deduct, because we are done with incomes in the P&L, allowable expense not in P&L, we now get net taxable operating income. So we'll start from the net profit we add, and then we minus those ones. So 527,614, and then 527,614 plus 48,800 plus 12,400 plus that 240 plus 2,600 plus 2,250 plus 1,500 plus 208 plus 256 plus 820 plus 2,800 plus 1,560 plus 580 plus 1,450 plus 1,168. Then this figure we minus the 84,000 minus 28,000, 28,000 minus 32,000 minus 16,000 minus 24,000 minus 14,400 minus 210 minus 8780 minus 656. We minus 1,300. We minus 563. and we minus 3100, and then we minus 82. That gives us 394, 155. Now, we said this, because this is a company and you tax the company itself, once you get the operating income, you add taxable investment income. Investment income. We add the taxable investment income. In this question, incomes are in the income statement. There was only one investment income, the last one, a general investment income. We said if it is not indicated, where an investment income is coming from, tax it. So this one is not indicated, so tax. So add investment income, which here we have been told it's 24,000. And since there isn't any other, this will give us the total taxable incomes. So we take the operating plus the investment incomes, which 394, 155, and then we add 24,000. That gives us 418, 155. Now, if you go to the required, we were supposed to get what? Compute the total taxable profit or loss of Zahari Processors Limited, and it ends there. There's no other question. But sometimes you can be asked to get the tax. Unless it is indicated it's an unresident or a foreign company, we said you tax at the rate of 30% because it's considered to be a resident. So tax, if tax was required, that is, if it was a requirement that we get the tax, so tax will be 30% of 418, 155,000. Now we add the zeros, the one that we had quoted here, because now we are outside of these zeros we had quoted. So we'll get 30% of 418, 155,000, which gives us 125, 446, 500. And so if you are asked to get the tax, that's what you do. So the taxation of the business ends there. And which case, in case you are told to use the gross profit method, or in case you have not been given the net accounting profit and use the gross profit method, you just have the same. You just start with the sales, cost of sales, and other income, less allowable expense. Then at the end of it, you'll get the taxable operating income, add the investment, and then if you are asked to get the tax, you do the same. So it's all about whether you have been given the net accounting profit or not, then you know the method that you're supposed to use. So for now, we are going to stop there until our next lesson. So kindly below this video, there is some assignment question, attempt, and then you see if you can be able to do it the way we have done it. Thank you very much.